It's Mike Lynch with AmeriFirst Financial. It's Monday morning, September the 12th, time for your Monday morning mortgage update. Hope everybody had a great weekend. I had a fantastic weekend. I actually went to Chico with the family and our son turned 32. Here's a picture of the family. If you ever go to Chico and you want a great steak, go to 5th Street Steakhouse. Had an amazing ribeye. Just so blessed to be able to have a great weekend with everybody. So let's talk about what happened last week and what's happening this week. Last week, we actually saw a sell-off in the bond market and rates got worse. One of the things that caused this is the Federal Reserve is still basically saying we got an inflationary problem. And we know that inflation is horrible for mortgage rates. And until this inflation gets under control, we're going to see these rates climb. Also, the Fed reinvesting back in the bond market and some other things. But again, we ended the week higher than we started. And if we really want to look at how this looks on the charts, this is the representation of mortgage-backed securities in the bond market. So each one of these candlesticks, we call it a candlestick. As I hover over it, you can see it represents a day of trading. You can see the full movement in that day of trading. And let's recap. There's basically two places people can put their money in: the riskier stock market or the safer bond market. So if they're putting their money in the safer bond market, money's flowing into that bond market. That's where mortgage-backed securities are traded. And rates will actually go down when money flows into there. When money flows out, then rates actually get worse. And so we can see this goes all the way back to June, and we can see that the market has had a lot of volatility. The green is moving up, means money is flowing into the bond market, rates are getting better. The red, money is flowing out, means rates are going up. And you can see for the last month, since August 2nd, we've seen an increasing trend of money flowing out of this bond market and rates getting worse. And we don't expect this to change much. The biggest cause of this right now is inflation. There's no question about it. Inflation is still a problem. It's not under control. The Fed's raising their Fed fund rate to fight inflation, and this is causing our rates to go up and investors not wanting to invest in that bond market because they're getting a worse rate of return. It's the bottom line. So let's talk about what we're looking at this week. This week, we're looking at inflation. That's going to affect mortgage rates. We're looking at what are consumers doing, and we're also looking at a treasury dump. So inflation, two of the biggest reports coming out this week are Consumer Price Index and Producers Price Index, CPI and PPI. We talk about this a lot. They come out every month. They give the Fed and us and economists an idea of what's happening with inflation. And we expect this number to be higher, but not as much. So the last number came out, went up, but it went up at a slower pace than it has in the past. This is good overall. Now, if we see the number come in above estimates, meaning inflation is higher than what everybody's estimating, that'll be bad for rates. Rates will go up. If these numbers come lower than estimates, that means rates will actually maybe improve. So CPI is coming out tomorrow on Tuesday, and the PPI is coming out on Wednesday. So we'll be paying a lot of attention to those two issues. What's the next thing? What are consumers doing? So a lot of consumer sentiment reports are coming out. Do consumers have confidence in the economy, or are they concerned about the economy? Now, there's something called the Michigan Consumer Sentiment Report. It comes out once a month, and that's been dismal for months now. And basically, if you and I, consumers, feel that things aren't going to look better in the future, then we're going to spend less money. And when the price of eggs and cheese and milk, the standards for the staples inflation, if those are higher, if gas is higher, if everything else is higher, we're spending less. And that means that the economy is going to slow down. So we've got retail sales coming out. They were zero last month. Zero means that we're buying less and we're paying more for everything. We know that's happening. And so this is really leading up into the biggest retail sales time of the year, the holidays. And so what's that going to look like this week? Manufacturing reports are companies making more stuff. If there's no demand, then they're going to make less. That's an indication of what consumers are doing. And then some actual reports where the Michigan Sentiment Report, where they actually talk to consumers and say, what do you guys think? And this number's been really low. So if these are low numbers, then that means the economy's slowing. It'll be good for rates. If they come above estimates where people feel, hey, it's not great, but we feel better, then actually could be worse for rates. And then the last thing is Treasury dump. our Treasury sales. Our Fed sells Treasuries, notes, and bonds to raise money. And the big one is Tuesday. They're selling 30-year bonds, and that is mortgage rates in a sense, or mortgage-backed securities. So if there's a demand for private investors, foreign investors, your 401ks, everything to buy those 30-year bonds, and if they buy more of those, then that could be good for rates. That means more of those bonds are being purchased, more money's flowing into the bond market, could be good for rates. So we'll be watching those things. So what are we looking at as far as moving forward this week? We're in a locking position. There's more risk to rates going higher than actually improving. So we're advising all of our clients to lock, don't float the market. If you have any questions about rates, please give me a call. If you know somebody can benefit from this video, please forward it to them. Have a fantastic week, and I'll talk to you soon. Bye-bye.